Hello, welcome everyone. Thanks for joining us today for the webinar. My name is Tony Caswell. I'm a Senior Marketing Manager for the Energy Refined Fuels business at DTN. Today's webinar is titled Navigating the Renewable Diesel Market, Supply, Demand, and Pricing Strategies, presented by Argus. Just a little housekeeping before we get started. This webinar is being recorded, and a link to the recording will be provided to all attendees in the next day or two. If you do have any questions during the presentation, please type them into the Q&A tool in your WebEx control panel. And if time allows, we'll address your questions when the presentation is complete. Now let's meet our presenters. Today you'll be hearing from two biofuels experts from Argus. Louise Burke is a Vice President of Business Development for North American Biofuels, and she's joined by Jackie Wrigley, a Biofuels Market Specialist. Now, without further ado, we will hand it over to Louise Burke.
Oh, great. Thank you, Tony. And it's a pleasure to be here. It's an exciting time to be in this market. And thanks for the invitation from DTN. So as Tony said, we'll be talking about the renewable diesel markets in North America. And of course, Jackie Riegel is one of our key experts on the consulting side, and we'll be going into that in great detail for you. So we're going to skip the next slide, which is our legal issues, and then go into really what Argus is as an entity. It's just some background. We're the largest global independent price reporting service. We provide market analysis, and our prices are used in contracts. So many of you on this call are looking to see what is a highly visible price transparent assessment. So we have them on the bio side. Specifically, if we move forward to the next slide, you'll see the kind of portfolio we have. We have global pricing, and in the US, we price renewable diesel, sustainable aviation fuel, all those sustainable markets that you are familiar with. We also price credits, LCFS, RINs, and particularly we price feedstocks that are used in renewable diesel production. We also provide forward curves and forecasts for many of you trying to determine what's going to happen in this market. So I think that's very important. And also we provide spot prices for the West Coast. Jackie will be going into that in detail, the Gulf Coast, the Northeast markets, and a renewable diesel margin indicator, which gives you a sense of the achievable value that producers have. And we actually have it based on the type of feedstock. So feedstocks are very important in this area. So for the agenda today, we wanted to really provide an overview of the market, where the supply is coming from, some of the international US Gulf Coast trade flows. You'll get a sense that this is not just a domestic market. We're going to take a deeper dive into the key factors that are driving the market, the demand for renewable diesel, the state credit programs, and also provide our views on the growing spot market, how some of the events we'll see going forward are going to affect that market, and really how best to price your renewable diesel for your customers. So I just wanted to start off on the next slide with a basic understanding and explanation of the difference between renewable diesel and biodiesel. Biodiesel and renewable diesel use the same feedstocks. It's made from vegetable oils or animal fats. The big difference is they're processed differently. So in the biodiesel sector, we use a process called transesterification. It requires blending also with petroleum diesel. You'll hear blend rates of anywhere from 2 to 20%, whereas renewable diesel although it's made from the same feedstocks, uses a different production process, similar to refining. So it's basically hydrogenation. It's considered petroleum diesel's low carbon twin, so that's very important. It meets ASTM D975 specs, and most importantly, it's a drop-in fuel. So it can be added into the existing pipeline systems, and it's really easy to incorporate into the diesel stream. And most importantly, it's used because customers want strategically to lower their GHG emissions. So on the next slide, we'll be going into this in much more detail with Jackie, but this is a snapshot of really why we have this market. Many of you are aware, most likely, that federal RINs and state regulations do incentivize renewable diesel supply. And this gives you a sense on the map of the various regions and also the national programs that are in place so that states, for example, and actually countries and companies can meet their decarbonization targets within the transportation sector. And fundamentally, subsidy schemes are really required. So on the slide here, you see at the federal level, we have the RFS program. It's been around for a very long time. It's really the set of blending mandates that dictate how much renewable fuels are blended in. And each of these biofuel molecules have RINs, and they create market signals for investment. So if RIN prices are high, it indicates a market perception that annual blending obligations are difficult to meet. So it kind of incentivizes and stimulates more investment in biofuels. So that's important to notice. And just from a historical perspective, this program was actually authorized in 2005 under the Energy Policy Act and expanded under the Energy Independence and Security Act of 2007. So strategically, the idea was really to boost renewable fuels. The second subsidy that Jackie's going to go into detail about is the Blender's Tax Credit. It's otherwise known as the BTC. Again, a U.S. federal scheme. That's going to end at the end of 2024, and we'll start to see some interesting changes going on with the Inflation Reduction Act. So in addition to the federal subsidies, we do have these state-based programs, and you can see them on this map. They're primarily U.S. West Coast. And they work by setting annual carbon intensity requirements for the fuels sold in the transport sector. Each state has their own version, and fuels with a CI level higher generate deficits, and those with lower CIs generate credits. So we can see that this actually impacts, if you look on the North American renewable diesel capacity slide that we have here, it's certainly impacted on production of renewable diesel. The California LCFS program has been in existence since 2011, and overall demand for renewable diesel has increased from 1 million barrels a year in 2011 to 28 million barrels by 2021, so pretty dramatic. By 2023, more than 50% of California's truck and train demand was met by fuels other than the petroleum diesel, and that's the renewable diesel we're talking about. And we do see that LCFS mandates are continuing to expand, and Jackie's going to go into that in some details. So at this point, California really absorbs a lot of the renewable diesel, but we do see that there's a lot more production coming on. So if all announced plans and projects are executed, we can see a ramp up to almost 6 billion gallons a year. So we see that market production is advancing very rapidly. So on the next slide, this gives you a sense of the location of where these plants are. So that's always interesting. So typical refining centers like the US Gulf Coast have a very large production base, that we also see some Midwest. So I believe the second largest renewable diesel company, HF Sinclair, has most of their plants based in the Midwest. We do see companies like Diamond Green Diesel, which is a 50-50 joint venture between Valero and Darling. So they're in the process of major expansion on the Gulf Coast. And also we see on the West Coast some really important transitions where two major refineries, the Marathon Martinez, which is now a joint venture between Neste and Marathon, is coming online this year. And then, of course, P66 Rodeo's facility based in San Francisco has already been producing renewable diesel, but is completely transforming over. So a lot of production that we'll see across the board. And you can also see, and I think it's important to recognize, you've got some Canadian plants, about 4 of them coming online as well. So lots going on both the operational side and as we saw, how much more we're going to come online by 2027, 28. So just on a final chat, I wanted to just mention the trade flows. I think that's really interesting to see. I did mention that it's not just about North America, because we do see some substantial renewable diesel volumes coming in from Singapore. So Neste has a large plant there. It hits the US West Coast. And we see a lot of the US Gulf Coast facilities also moving product through the Panama Canal. and it's going into the U.S. West Coast. In fact, our company tracks vessels, and I was just reading the latest report, and we saw that there's 4 vessels about to hit in the month of June on the West Coast, and one of them even comes from Newfoundland, which is in Canada, and so there's a producing facility there called Brea. So you do see that there's the ability to have renewable diesel volume coming in from international locations, and also for the domestic plants here to ship to other regions, including Europe. So with that, gives you a good overview of what's happening, and I'm going to turn over to Jackie to provide her insights on the renewable diesel market. Jackie?
Thank you, Louise. That was a great overview, and thank you all for being here with us. I'm going to dive into the U.S. credit market, kind of giving you a market update of what's been going on there. So I guess let's start with the federal and state level credits. At the federal level, D4 RIN credits, pictured in the left graph, which are generated from RD production, they've been falling to lows unseen since early 2020. And since the new multi-year biofuel blending mandates passed last year, which did not really show ambitious targets for the RD category, D4 prices have come down as a result. And you'll see how far down D4 RINs have dropped in the left-hand graph. The rally in May towards the tail end of that graph was likely attributed to a run-up in the soybean oil heating oil spread, or the BOHO spread. The higher BOHO was largely attributed to a bullish trend in soybean oil prices following a grain crushing report from the National Oilseed Processors Association that basically indicated lower than expected stocks of soybean oil domestically. And you also had less Brazilian exports amid flooding in southern Brazil, supporting soybean oil futures in May as well. Then at the state level, you have California LCFS credit prices pictured on the right, and they're down on record credit supply. The latest data on credits available for compliance indicated the credit bank grew to a record 23.6 million tons by the end of last year, which added pressure to an, ongoing rulemaking process, as we know that's going on as more production of RD inundating the state comes online. And in May, actually, LCFS credits fell by $14 per ton on the month to $48 per ton, as sellers reacted to kind of a combination of lower petroleum fuel demand and accelerating supplies of lower carbon fuels, along with continued supply of imported UCO feeding RD and SAF producers. So let's kind of take a closer look at the state of the California LCFS market. I guess you'll see here that we're looking at the California LCFS credit bank in basically yellow. And unlike RINs in the federal RFS, LCFS credits do not expire. So California has amassed nearly 23.6 million credits available for future compliance in yellow. And that's already enough credits to offset a year's worth of new deficit generation without any renewable fuel use in the state. And this has had the most stark consequences in California's liquid diesel pool, as demonstrated here from state LCFS data. What you're seeing is RD, the green bars, over the life of the California program, slowly and then quickly displacing carb diesel, the yellow bars in the state fuel supply. And renewable diesel alone began making up more than half of the diesel pool for the first time last year, shrinking the market space for petroleum diesel. So this kind of begs the question for us as a price reporting agency of how do you price renewable diesel when the fuel it's replacing is kind of disappearing in California? It's entering the export market more and going to Latin America. And that's where we, Argus, can provide value. So we're going to now dive into our set of RD assessment offerings. So let's kind of start with what we've recently launched. Mid-November of last year, we launched 4 bulk assessments for RD transacted at the head of the Kinder Morgan pipeline system in California, 2 for LA and 2 for San Francisco, each with different pricing structures. Then in mid-April this year, we launched 4 bulk assessments for RD delivered by rail to terminals within the LA and San Francisco regions, each with 2 different pricing structures as well. And here you'll see that Argus California R99 indices are published against both a NYMEX ULSD and CARB ULSD plus attributes basis. where the attributes include the cost for petroleum diesel under California's LCFS and cap and trade programs. And there are 3 of these attributes / costs as listed at the foot of the table. And importantly, the assessments exclude all credit value. We've also recently launched assessments for FOB barges in US Gulf Coast and delivered barges to New York Harbor. They are calculated prices. So the Gulf Coast assessment is a calculation of the high and low value outlets available in the Gulf. The high represents the LA head of pipe assessment, less marine freight from the Gulf to LA, while the low is disposition across Texas truck racks and reflects the Texas state excise tax credit, less incremental freight and logistics costs. The New York Harbor assessment is our Gulf Coast assessment plus marine freight to New York Harbor. So this is our full suite of R99 indices across the country. And this is just a map of the Kinder Morgan system. Again, all of our California RD bulk indices are market survey assessments, with the exception of New York Harbor and Gulf Coast. And in California, essentially, those market survey assessments capture the spot value for head of the pipeline transactions of R99 at Kinder Morgan's terminal, Watson Terminal near LA, and Kinder Morgan's Concord Terminal near San Francisco, which both receive RD by vessel and local domestic production from Marathon Martinez and P66 Rodeo. Waterborne RD reaches the Watson and Concord terminals by foreign flag vessels from mostly Neste Singapore facility and by Jones Act vessels from the Gulf Coast producers via the Panama Canal. And our bulk indices also include market surveyed assessments that reflect the spot value of rail cars delivered to terminals within a 200-mile radius of LA and San Francisco, as shown on the map here. The methodology for the assessments that we have for head of pipeline is visualized in this graph here in this slide. The first pricing structure is at the top. This is how the market is most currently trading for transactions at the head of the pipeline. It starts off as a CARB USD basis, adds on 3 avoidance costs of conventional diesel in California, which are comprised of a California carbon allowance cost for diesel, the LCFS deficit cost for diesel, and the LCFS deficit cost for the crude CI of diesel, and then ends by adding on the market survey diff, which Argus uncovers on a daily basis. The second pricing structure is at the bottom. Head of pipe transactions have traded as a premium to NYMEX heating oil before. And because CARB diesel is becoming less and less liquid, as we discussed earlier, we felt it was important to also publish an R99 diff to the NYMEX basis. And we do this by normalizing from the CARB-based pricing structure, which involves taking out the front month NYMEX USD futures price from the outright LA head of pipe R99 CARB-based price shown on the first line to arrive at a differential against NYMEX heating oil, which is usually a premium. Not visualized here, but very similar is the methodology for delivered rail cars. Because those have predominantly been trading as a diff to NYMEX heating oil, we do the inverse of what is shown on this slide. We add the market survey diff to NYMEX heating oil to get an outright price on that basis, and then subtract from the outright price CARB diesel plus attributes to arrive at the differential to CARB USD. So let's kind of dive into what these CARB USD quote unquote attributes represent. All 3 of the line items shown here add cost to diesel and thus value to the diesel alternative, renewable diesel. They're viewed as the avoidance cost of conventional diesel in California under the LCFS and cap and trade programs, are called CARB USD attributes. The first one is the California carbon allowance cost for CARB diesel. This is the compliance cost for California cap and trade program levied on the diesel fuel position holder at the terminal, and is based on the Argus assessment of prompt month allowances. The second one is California LCFS deficit cost for CARB diesel. So petroleum diesel in California, it is obligated under the LCFS. So this is a cent per gallon cost based on the Argus spot LCFS credit assessment. The last one is the California LCFS deficit cost for the crude CI of CARB diesel. And this is a cost to account for the crude CI score that CARB updates every year. If it goes above a certain level, the agency adds more deficits to accounts. And it's an additional penalty when crude is processed in California to produce diesel. This basically shows the makeup of the LA head of pipe outright price on a cent per gallon basis. You'll see that NYMEX heating oil makes up by far the largest portion of the outright price, followed by the California carbon allowance cost for diesel, and then the market surveyed diff. This diff is expected to make up a larger portion of the outright price as more supply comes online, however, and could eventually become the second largest component of this pricing structure after NYMEX heating oil, as more RD capacity coming online would weigh on the head of pipe diff. So we've reviewed Argus's California R99 methodologies in quite some detail, but I wanted to dive into our R100 assessments as well, which include the value of RD's environmental credits. We have basically 4 calculated prices for our renewable diesel R100 delivered into California, which are inclusive of credit value. And the price as pictured here is the sum of the value of fossil diesel plus avoidance costs for fossil diesel in California and the value of LCFS credits, the BTC and RINs. When arriving at the LCFS credit value, what we do is we take the weighted average of CI pathways by plant capacity. So these are 100 values. They represent basically the maximum achievable value an RD producer can get for their product when selling into California. They are daily calculated prices for soybean oil, tallow, corn oil, and UCO-based 100% R100 RD sold into California. And this here is just a summary of the subsidy schemes currently in place for biofuels in North America. Louise mentioned these. At the federal level in the US, we have the RIN credit system under the Renewable Fuel Standard. We also have the $1 biomass-based diesel blenders tax credit. And at the state level, we have low carbon fuel standards in California, Oregon, and Washington. And so visualized, pictured here are some brief descriptions for these subsidies for you to basically kind of review in your own time. I believe the deck will be made available after, so shouldn't be a problem there. And this is basically a waterfall chart of our UCO-based R100 assessment. You'll see that the NYMEX heating oil followed by RINs, then BTC and LCFS credit value on a cent per gallon basis make up the largest portions of the R100 outright price. And just keep in mind, remember, R100 includes credit value while R99 does not. So we've reviewed Argus's California R99 and R100 pricing methodologies in quite some detail, but I wanted to dive into what's been developing in the spot market these past few months. So shown here are LA and San Francisco head of pipeline R99 diffs against CARB USD plus its attributes. You'll see that the California RD head of pipeline market gained strength for most of November. It was buoyed by a drought that had restricted Panama Canal transits and raised costs for Gulf Coast producers. And while the canal issues stifled market activity and vessel deliveries in September, Argus biofuel vessel tracking data showed that deliveries to California began to pick up in October along with spot market activity. But supply remained tight, especially as RD plants also ran at lower than projected nameplate capacities through November. By the start of December, however, diffs started to decline as RD volumes started to obviate the Panama Canal backlog and get transported around Latin America to the West Coast. Ample supply from abroad was also making its way to California. And in January, R99 diffs reached 5-month lows as RD plants in the mid-continent and Gulf Coast picked up their run rates from the fourth quarter. Then we reached February, and these diffs saw some signs of improvement on the back of weaker credit values, but stayed pressured compared to January. Unfavorable weather conditions and seasonally low interest from the ag sector in February constrained demand and kept diffs low. While for March, local supply of RD tightened with Marathon Martinez and P66 Rodeo running well below 50% of their capacity. March batches on the Kinder Morgan pipeline system were also cut after some shippers were long in February and marine deliveries slowed. The most recent uptick in May to present, as you can see on the graph, can be attributed to basically signs of supply tightness. Production of other diesel fuels in California, which includes export grade EPA USD and RD, fell by 41% over the week ended June 7th to 38,000 barrels per day, which is their lowest level since July of 2022. And other diesel fuel inventories ended the week at 866,000 barrels, which was basically the lowest volume on record since CARB began reporting the data in 2005. So this is some background as to how the spot differential has evolved. But what are some other factors that could be propping R99 differentials in California of late? And really that's kind of twofold. It could also be lower waterborne imports in May and weaker RD margins. Here you'll see the imports of RD into California. All of the foreign imports, with the exception of some of the shipments in May from the Come By Chance refinery operated by Brea Renewable Fuels, are Neste. And we suspect that Neste may be sending more volumes to California this year to take advantage of the $BTC before the 45Z clean fuel production tax credit kicks into place starting in 2025. The CFPC under the IRA will not give credit to foreign producers like the BTC currently does. Another factor that could be supporting R99 diffs in California of late are RD margins at the Gulf Coast. Here you can see a view of what direction RD margins have taken, largely pressured by lower USD, D4 RIN, and LCFS credits. And this is telling because it's despite weaker prices for renewable feedstocks over the past few months amid rising imports of those feedstocks into the US Gulf Coast. So keep in mind, the lower the margin, the less economic it becomes to produce RD, which can raise those offers. There's an inverse relationship between RD margins and R99 head of pipe diffs, because as RD production margins deteriorate, producers are prompted to increase the level at which they offer the product in the spot market to cover their costs. In this chart, we're just showing the foreign exports of RD from the Gulf Coast. Canada is the largest export destination, and this is largely because of the implementation of the Canada Clean Fuel Standard in July of last year. Since December of last year, however, the UK, Norway, and EU member states have emerged as more frequent exporters. So certainly something to keep an eye on. And just to touch on R100 again, I just wanted to discuss kind of the pricing, the calculations, and how they've evolved over time. So here you'll see Argus R100 prices. Again, they represent the full achievable value a producer of RD selling into California can receive depending on the feedstock they use. And this can be explained in the left-hand graph, which shows the monthly average of our 4 California R100 prices. They are calculations comprised of the replacement fuel value, petroleum diesel in dark blue on the left graph, plus CO2 reduction value as measured by the LCFS credit value in purple, the D4 RIN value times 1.7 in pink, plus the dollar per gallon biomass-based diesel tax credit in green. We also include the avoidance costs for diesel. Also to note, the right table visualizes what these daily prices look like in California since we launched them. The variation in pricing here is basically the LCFS credit value you get for each different feedstock-based RD, as each feedstock warrants a different CI value under the California LCFS program. So the message in these graphs is basically that the price of R100 has been declining for the past 2 years. Market participants looking to produce more renewable fuels continue to take notice of the falling credit values. And as producers rely on these incentives as a form of revenue, concerns have been arising from investors funding projects designed to capitalize on credit prices. As RIN and LCFS credit prices fall, corresponding expected revenues dependent on those credits fall in tandem. And this is largely why we have seen independent refiner Vertex pause their RD business and pivot to production of conventional fuels a few weeks ago. That was announced. So let's look at our forward view now for RD. Listed here are several events in the North America renewable fuel sector that are expected to affect demand and supply. And we wanted you to have this on hand because we'll be sharing the deck again, but know that listed here is one event that should impact federal biofuels demand through the RFS. So that it's that first top event from the 2026 through 2028 RVO is expected to at least be proposed by spring of next year. in their prior proposal for 23 through 25 compliance years, they had included eRINs, but then in the final standards, they had excluded them. There's no current timeline for the eRINs, but it may appear again if we maintain the current administration. It could come up again in the spring 2025 RVO. And they could also adjust again for, make the biomass-based diesel category requirements stricter. For the 23 through 2025 RVO, they really assumed that feedstocks supply would not be ample enough to meet the amount of capacity set to come online. But if you look at the regulatory impact analysis for the 2023 through 2025 RVO, you'll see that EPA kind of underestimated the amount of imports of feedstocks and RD for those years, which is making us inclined to believe that they're likely to adjust the mandates higher for those 2026 to 2028 years. It may not be exorbitant, but it should be an increase from what we've seen for the last 3 years. And then another event that should impact demand is through RD tax credits. Again, the expiry of the dollar BTC, it switches to the CI dependent CFPC, which is a domestic tax credit and will depend on the feedstock used to produce that renewable diesel volume. So if you're using soybean oil to produce RD, you may go from $1 to receiving $1 in 2024 to potentially $0 in 2025 because it doesn't meet the CI requirements for the CFPC. So that's certainly something to keep an eye on as an RD producer. And then some other events that should impact biofuels demand are through the LCFS programs in California, Washington State, Oregon, and Canada. I'll just briefly touch on California. They're evaluating a reduction target that should become stricter by 2030, as well as a one-time accelerated reduction of 5%, 7%, or 9%. They're expecting the agency to have revised rulemaking language in place before a board vote on the proposal that is scheduled for November 8th. So we're keeping a close eye on that. And I'll give you kind of our views on how this could impact LCFS credit prices moving through 2025. But another 3 events that should impact RD supply is through some plant expansions on the West Coast and Gulf Coast. So we're still waiting for Chevron REG Geismar to expand to their full announced expected capacity. It was originally supposed to expand in this year, but that timeline was pushed back. I'm sorry, it was supposed to come online expansion through 2023, but it's since been pushed back to this year. And we're also, of course, waiting for P66, Rodeo, and Martinez to fulfill their expansions as well. Here, I just want to review quickly where we have LCFS programs in place. Louise touched on this, but we have California, Oregon, and Washington state markets. Those are all active. Canada has a federal program called the Clean Fuel Regulation that includes many LCFS components. Lower carbon fuels supplied to Canada began generating provisional CFR credits in the second half of 2022, and enforcement began in July of last year. Liquidity was thin to start, but we started publishing spot prices last May. And then British Columbia operates a concurrent provisional LCFS market. In BC, you can stack those 2 credits in the same way that you can stack LCFS and RINs in the US West Coast states. New Mexico, they've adopted a program. Illinois and New York are exploring programs. And it's important to note that Washington State tried multiple times before it passed its LCFS. So the same thing could happen in other states that have tried but failed to pass an LCFS in the past. So let's jump now into what I was talking about earlier about our forward views on the pricing for the credit markets and R100. So these views are not really expressed in our daily reports. This is predominantly kind of a short-term view that comes out of our monthly biofuels outlook. But you'll see that throughout the remainder of the year here, higher US RD production is expected to cut into RIN credit prices and pressure biofuel production margins, potentially curbing industry growth by November to December, when we expect D4 RIN prices to reach as low as around 400 cents per RIN. RD production in North America last year jumped up by like 36% to a record 3.45 billion gallons, but rising production has cut the value of D4 credits by 75% over the past year, as credit generation has outpaced the EPA's biofuel blending targets. Some refiners have already shifted their strategic focus to compensate for lower RIN values, with some cutting back on renewable fuels production, and that would include Vertex. Moving into January, we expected D4 RINs to rise to around 65 cents per RIN amid a tighter RIN bank, and to steadily continue their ascent before reaching over $1 per RIN in July, by which point EPA is likely to have increased the advanced biofuel mandate for at least the 2026 compliance year, given again the higher than expected imports of feedstock and RD last year. Lower domestic and foreign D4 RIN generation is expected to kick in as the $1 per gallon biomass-based diesel blenders tax credit expires in 2024 and is replaced by the CI-dependent 45Z domestic producer tax credit. Again, the 45Z only applies to domestic production and makes imports ineligible, which should lower D4 RIN generation. 45Z is also expected to increase demand for CI-advantaged UCO and tallow, which should result in higher prices for those feedstocks, thus bolstering D4 RIN credits, as the increased feedstock cost negatively impacts biomass-based diesel profit margins. And in terms of California LCFS credit prices, those are forecast to start recovering next year as well. Again, on November 8th, CARB will have a board meeting to vote on the proposed CI targets for 2025, and staff plan to release final language for a 15-day comment period ahead of that meeting later this summer. Meanwhile, you have participants, they face at least 2 more quarters of targets that have seen surplus credits double in just years. So we anticipate prices to reach as low as around $40 per ton in October, once 2 additional quarters of LCFS program data reveal new historical builds. But prices are expected to rise moving into next year, when CARB implements at least a 7% step down in CI reduction for that year. We are also viewing that in the near term, lower diesel pricing is expected to keep R100 prices and margins pressured through December. RD prices are expected to press lower in June, primarily as the underlying weakness in CARB diesel and LCFS credits outweigh higher D4 RINs. Feedstock costs will mostly be unchanged, except for soybean oil, which is forecast to rise by around 6 cents per ton. All this means weaker margins for producers and below the record low set in May that we would expect to persist for the remainder of this year. So our forward view is that R100 prices, they should hold relatively steady before dropping at the start of 2025, as the $BTC is removed from offtake arrangements, but should start to rise thereafter in tandem with increasing D4 and LCFS credits. So that's kind of, an overview of where we see markets going for the next few months, kind of how the fundamentals work, how you can use our assessments and helping your business decisions. But I think we're going to open it up to a Q&A now.
Yeah, absolutely. Thank you, Louise and Jackie. We're going to take some questions now. We do have a few in queue. First, Jenny asks, can you clarify what concurrent LCFS markets means?
That's a good question. I'm trying to think of the context in which I said that, but I believe I just meant all of the current LCFS markets that exist, which would be California, Oregon, and Washington. And then you can view the Canada CFR as kind of an LCFS type of program, and British Columbia. Again, not sure what context I use that term in, but I believe that's what I meant by that.
Great, thank you. Our next question, Zach asks, you mentioned that renewable diesel is a drop-in fuel versus biodiesel. Can you provide more detail on this?
Sure. It's really the processing of the product. So with biodiesel, it's called FAME biodiesel, fatty acid methyl ester is what the abbreviation stands for. And it's not a hydrocarbon fuel. So think about hydrocarbons as just having two molecule chains, hydrogen and carbon. So renewable diesel just has hydrogen and carbon, just like petroleum. And so what happens is that the FAME biodiesel has oxygen as well. So that can limit the length of time it can be stored due to oxidation that can cause corrosion and clogging of fuel lines. So it has a higher cloud point as well than petroleum diesel, and that can cause gelling in the fuel line. So that's not what happens with renewable diesel. So it's really that additional component, and it's the processing method. So it's not a typical drop-in fuel, whereas renewable diesel has essentially the same chemical characteristics as diesel, and therefore can be used the same way as a drop-in.
Wonderful. I think we just have one more question. Andrea asks, how exactly are rail cars delivered to California from the U.S. Gulf Coast, and how do those logistics work?
Yeah, I think I can address that question. So I guess taking in mind the biggest producers at the Gulf Coast, or the biggest one is Diamond Green Diesel, and maybe let's use PBF St. Bernard joint venture as another example. But my understanding, at least, is that Diamond Green Port Arthur and Norco Rail to California, in the way that Norco has an agreement with ITT, and then they pipe RD from Norco down to St. Rose, and then that St. Rose terminal loads barges and loads it across the river to the Avondale terminal, their other terminal, and then load the barges into rail cars from there, because that's the terminal that hits the Union Pacific line. And Norco and St. Rose are both served by CN or KCS. So in order to get to a Western railroad, they have to do this. Again, also my understanding of PBF St. Bernard is that they, I think, do not have current rail capacity at their plants. I would confirm that with them, but they are CSX served. So if they want to get on the UP or BN, they have to go to Houston usually. So the CSX goes up to Canada, but CSX can also go to Baton Rouge. So, and then to get to the UP, but UP can be costly from what I understand. So I think those are some examples of the ways in which RD producers get their production onto rail cars and then send it on certain lines to the California West Coast.
All right. I think we do have a couple more questions that just came in. Casey asked, you mentioned RINs and California LCFS are expected to increase in 2025. Do you have a projection for Oregon LCFS in 2025?
That's a good question. We don't formally forecast Oregon LCFS credits, but usually they tend to follow each other, California and Oregon credits. I know Oregon's a little bit of a different market in the sense that it's more constrained in terms of logistics and getting RD around the state, but I would say they would usually track each other. So you should anticipate the same type of movement in the Oregon LCFS credit price. We are looking to forecast more LCFS programs out of consulting. So we are looking to eventually price or forecast CFR credits. And in that initiative, we would hope to be able to forecast Oregon and Washington as well, but we're still in the preliminary stages. So I can't give a formal view.
All right, wonderful. I believe we've addressed all the outstanding questions. If any of the attendees do have any additional questions, please feel free to reach out. to Jackie or Louise. If you would like to maybe advance your slide, Jackie, I think you had some contact information there.
Yes.
Otherwise, we will also share their contact information in the follow-up emails, where we will also provide the presentation in the webinar recording, as well as the presentation file itself. So thank you, everyone. I do appreciate you being here. Stay tuned to watch your inbox. We'll be sending out follow-up information here very shortly. Thank you, Jackie and Louise.
Thank you.
Great. Thank you so much.